Reserve requirement ratio is higher because this ratio is set by central bank who is an agent for the government. That's why it is included under the government policy. We have seen that the government policy has two types of policies, that is fiscal policy, which we have seen in the previous, and the monetary policy. And the monetary policy is applied by the central bank, where the central bank decides on the rate of interest rate and reserve requirement ratio. So now we are looking at how the reserve requirement that is set by the central bank affects the inflation and employment. If the bank's reserve is higher, whether in their profit or their initial capital, if it's higher, to understand this we should know how the banks lend their money. As we know, the banks took individuals' money in the form of deposits and lends for individuals who want that money or for the borrowers. However, if the bank collected some amount of deposit, however, the central bank took most of the deposits in the form of reserve, this bank will not have enough money to borrow to its customers. For example, in a situation where the reserve is more than 50%. This will have a great effect on the money supply in the market, because as long as people do not borrow from the bank, the money supply in the market will not grow or it will decline. So when the money supply declines, the demand for goods and services will also decline. This will affect the overall inflation, because when the demand falls, inflation will decline. As long as people do not borrow money and work, they will not create different companies, they will not create different job opportunities for others. They will not have enough money to pay for their employees, because the total money supply in the market is very low, or the money is not in the hands of individuals. Hence, this has a good effect by reducing inflation. However, if we see the job opportunities or the total employment that will be created in that country, this has a negative effect on the job opportunities that are created in that country. But what will happen when the reserve requirement is too low, like 10%? This time, the banks will collect in the form of deposit too much amount of money. However, they will not reserve most of it to the central bank. This means they have the ability to lend to different borrowers or to different customers. At this time, people borrow from the banks in order to start up their business or to work on it. This will, as more and more people borrow from the bank, the total money supply in the market will increase, which makes the money in the hands of individuals. That creates a higher demand for goods, products and services. This will make the price for goods and products will higher, which increase an inflation. However, when people borrow money from banks, the total job opportunity will expand. So let me take 1 minute and summarize all of the impact of government policy on interest rate and inflation. A government policy is divided into monetary policy and fiscal policy. Fiscal policy is about controlling the tax revenue and expenditure of the government. When the tax collected is higher than the spending of the government, this will decrease the total money supply in the market, because money is collected in the form of tax, which lowers the demand and reduce inflation, but reduce employment rate, because people are being taxed higher amount. When the government expenditure is more than its revenue collected in the form of tax, the government needs additional money to finance its deficit, and when it spends all of that money, the total money supply in the market will skyrocket, which increases the demand and inflation. However, it's not collecting higher amount of tax. Incentive to work for individuals will rise, which increases the employment, even if it creates higher inflation. This is a monetary policy, fiscal policy. And a monetary policy is applied by the central bank by increasing interest rate and the reserve requirement. When the interest rate increases, people deposit their money, which reduces the money supply, also reduces the demand and the inflation. When the interest is too low, however, people deposited their money rather than investing. As long as there is no diversified investment in the country, job opportunities will not be there too. When the interest rate is rise, I've talked about when the interest rate rises. Now let's talk about when the interest rate falls. This time people try to borrow, increase the money supply, demand and inflation, but decreases employment opportunities. For the monetary policy, it's all what we have seen in this video. The other one is exchange rates and